Thanks for having me, everybody. My first day back at work was yesterday, so great to kick off the year at a function like this, and great to see such a well-attended audience as well. Fantastic to see. Look, so much happened last year. There's so much more happening this year, so I could talk all morning. I know you don't want that. I'll try my best to sort of squeeze it into 10 minutes, and then we'll do a bit of Q&A. But last year, a really challenging year for investors. Obviously, New Zealand shares down, I think down about 12%. That's the worst year we've had since 08. The US market was down about 19%. That's the worst year since 08. New Zealand house prices fell 14% nationally last year, and the Reserve Bank data goes back to the late 70s, and I haven't been able to find a 12-month period where we've seen a bigger fall. So everything was difficult across the board. Bonds were down 5%, New Zealand corporate bonds, and I think that is probably what made last year feel like such a tough one for many investors. Usually, you know, we see down markets in housing and in risk assets like shares all the time, but it's very unusual and rare to see bonds have a bad year, or for those two asset classes to have a bad year at the same time. The last time you had bonds and shares both falling was 1994, I think. So that really did shake a lot of people, because if you're an investor with a bit of everything, then usually if your shares aren't doing well, your fixed income is, or vice versa. So it was a tough year for all. Inflation was obviously a big part of that. Inflation high all around the world. Here in New Zealand, it peaked at 7.3% in the June quarter, so that was the highest since 1990. It's come down a little bit since then. We'll get more data out this morning. In the US, it hit 9.1% back in June. That was the highest since Ronald Reagan was president back in the early 1980s. And in places like Europe and the UK, it was double digits. Part of the reason was obviously that energy crisis. So the response to that was for those very low interest rates and money printing and QE of the COVID area to be unwound. And we saw sharp quick increases across the board from central banks. So here in New Zealand, the OCR started last year at 0.75 and it ended the year at 4.5, which is a hefty move. That's the highest since early 09. In the US, they started the year pretty much at zero, and they were still doing the QE, and they ended the year with their policy rate at 4.5%. So that's an exceptionally fast pace of monetary policy tightening, 425 basis points in a calendar year. If you think back to 94, which was a tough year for bonds, that was 250 basis points from the Fed. If you go back to the Volcker years, Volcker did 400 basis points consecutively, once in 79, once in 1980. So to go 425, it's pretty much the fastest we've seen ever from the Federal Reserve, the world's biggest central bank. And I think that was a really big factor. It's not just the nominal level that interest rates have got to, it's the pace that we've seen them rise. So we sit here this year and looking ahead, I think inflation and interest rates will still be a big driver of how the year plays out, and we've got some good news on that front, because we are seeing the pressures moderate. So you think about inflation. US inflation for December came in at 6.5%, so that's still far too high, still well above where the Fed would like it to be, but it's fallen for 6 consecutive months. It's back to sort of early 2021 levels, and it's way down from that 9.1. Here in New Zealand, we'll get our data out in a couple of hours. It'll still look high. The expectation is that the annual inflation rate will come down a little to maybe sort of 7.1-ish, so heading in the right direction. I'll be watching the quarterly numbers more closely. It'll be that if it's got a 7 handle, that'll be what's on the 6 o'clock news. But it's important to remember that that's picking up all of those sharp increases from a year ago. And the expectation for the December quarter is that the pace will be 1.3% for the quarter, which is still too high, but that's actually the lowest that we'll have seen since the June 2021 quarter, sort of 18 months ago. So things are going in the right direction, and I think that'll continue, because when I look at all the indicators out there, whether it's of supply chain blockages and issues, whether it's pricing intentions, all of the other reliable indicators of future inflation, they're all coming down. So things are moving in the right direction there. That's a good thing, and that's one of the encouraging points we've seen this year. It's one reason why markets have had a good start to the year. That does mean, I think, that the end of the central bank hikes is within sight. So in the US, they're at 4.5. Markets are expecting them to sort of peak out at about 5 over the next couple of months. So you might have a couple more rate hikes in the US, and that's it. They'll pause. Here in New Zealand, we're at 4.25. The Reserve Bank in November had suggested they'll get to 5.5. Maybe they will. Maybe they won't have to go quite that far. I'm a little optimistic that if inflation does prove to keep slowing, they might not need to go as far as that, but even then the end is within sight. So those are two of the good things that we're seeing out there, and that's really encouraging. The inflation peak is behind us, and we are most of the way through these interest rate hikes. The bad news is that we haven't sort of seen the full impact of that on the economy. Because those rate hikes have come so quickly, it hasn't flowed through to the average person on the street in terms of mortgage rates, and you're just starting to see the economic indicators take a pretty serious turn for the worst. So I think the good news is that inflation's coming down. The bad news is that one of the reasons it's coming down is because we're heading into a much more difficult economic period. Maybe that means recession, maybe it doesn't. We'll have to wait and see. But that is the tug of war that I think you'll see play out across markets this year. You'll have those positive factors of falling inflation and central banks set to pause and do no more this cycle, versus the economic issues that we will face as the year goes on. So for investors, it makes for another challenging year. I don't think it's going to be as bad as last year. I think this year won't necessarily be a fantastic year, but I don't think it will be as bad a year as we saw last year. If I had to guess, I would say bonds will have a good year, because we've seen interest rates come up, so you're now getting good income from your bond portfolio, and I believe that interest rates are at a point where they sort of either go sideways or maybe even sort of drift lower if the economy sort of does it tough. So I think bonds will perform well. That's good. That provides opportunities for investors. As far as shares go, impossible to say. If there is a recession ahead, I suspect there is a little bit more weakness to come. You know, really interesting to note that in the US, it's very rare for the US share market to reach a bottom before the recession. The last time we saw that was the 1940s, coming out of World War II. Before that, it was in the 1920s. But in the 12 recessions that we've had since the 1940s, the share market has never bottomed until the recession is upon us. So if you think a recession is ahead in the US this year, then history would suggest there's a good chance we will sort of maybe go close to retesting those lows from October. So it's still a time for caution. It's still a time for playing it safe. But important to remember, don't play it too safe. I think for long-term investors, periods like this bring opportunity. And if you're investing for the long term, then it's these periods of uncertainty, it's these recessionary times, it's these tough times that you actually want to be buying. You know, you look back at the GFC or the COVID recession or other periods through history like that, it was actually a good time to put capital to work. So people need to keep that in mind and make sure that they don't get too negative and miss opportunities. Final parting comment, I think for all of us involved in the industry, everyone here in this room, periods like this are times when our clients need us, when everyone needs us. So the industry has a much greater role to play in a year like 2023, just like it did last year, than when you're in a raging bull market and life's good, it's easy, anyone can be a rock star investor because things are just going up. But it's periods like this where clients and investors and the people out there need our support and our guidance and our advice. So I think that's something important for us to keep in mind too.
Morena. And thank you, Mark, for those great insights. I think I got challenging, fast-paced, play it safe, but capture every opportunity that's coming up.
Yep. Like
Perfect.
any good economist or strategist, I'm hedging my bets.
Good work. So I pulled out my questions actually from the fireside chat with Grant Robertson back in 2017. The headline at that point was a rise in interest rates from 4.85% to 5.85% would lead to a 12% increase in fortnightly repayments. So on the theme of politics, and if you were Chippy being sworn in today, what would your focus be?
Yeah, it's going to be interesting. I think, if you look at the sort of rhetoric out there, people believe that this has shifted things further in favour of a change of government. I wouldn't underestimate Hipkins. He's an experienced politician, he's quite astute, and if he is able to take the opportunity to maybe reset some of those unpopular policies of the last 12 months, migration's a big one for me, those immigration settings. That's something I hear right up and down the country from businesses that I talk to as something we haven't got quite right. I know there's other ones too. There's the farming sector, the business sector don't feel as heard by the government as they believe they should. There's the talk around sort of three waters and co-governance. So whether he'll walk back or water down some of those unpopular policies, I'm not sure, but I suspect he will take the opportunity to try and distance himself and reset things to a degree. So my suspicion is that the election could still be closer than many people think if he uses that opportunity. So I wouldn't be underestimating him.
Thank you. There's lots of great questions coming through Slido, so keep those questions coming through. A question come through around, would appreciate your thoughts, Mark, please, on tackling inflation through increased KiwiSaver contributions versus increasing interest rates.
Yeah, that's a tough one. I mean, inflation, you look at the causes of inflation and it's multifaceted. I think it was the San Francisco Federal Reserve that did some really good work looking at US inflation, and what they found is that probably 50% of the inflation pressures are supply side related anyway. It's because of shipping channels that aren't working as they should. It's because of factory closures in China, and that's another positive that we'll hopefully see change this year. It's all of those factors. So it's not just the demand side pressures, which is all of us spending money. So I think some of those supply side issues, you've just got to wait for things to unblock, unclog and go back to normal, which we are seeing happen. Interest rates, raising interest rates takes money out of our pocket. It makes life more difficult. It makes us curb our spending. It encourages us to save or invest rather than spend and borrow. So that'll work, and it is working. We just need to give it time because there's a lag, particularly here in New Zealand where we all fix our mortgages. We're quite different to the Aussies, just an example, where they have, I think 2/3 of their mortgages are on floating rates. So they get that cut through from a higher interest rate immediately. Here in New Zealand, the Reserve Bank increased the OCR, and it's not until we go and refix the mortgage that it actually hits us in the pocket. That'll work, that'll happen, and it is happening. We just need to give it a bit more time. KiwiSaver contributions, look, as an industry, we'd all like to see that. We'd like to see the government, and this government, as opposed to the opposition, the current opposition has been more proactive in terms of growing and building KiwiSaver, and it was obviously their initiative in the first place. So as an industry, we all want to see that. We want to improve the savings backdrop, and I would love to see more incentives, be they sort of on the tax front or otherwise, to encourage that. But on inflation, I still think higher interest rates is the best tool to impact that demand side inflation, and sadly it does come at a cost.
And so on that point, I think, do you see a risk of the RBNZ going further on rate hikes? You touched on it earlier. Yeah,
they'll go further from here. So they're at 4.25. The next meeting is next month, February. So, people are talking whether it's 0.5% or another 0.75. I'm probably in the former camp. I think I'm hopeful that if we see further signs of moderating inflation later this morning and other indicators that we all follow, forward-looking ones sort of point to things coming off the boil. We know there's a whole lot of people that have refixed their mortgages in the first 6 months of this year, and that will be ugly for some people, and it will impact the economy. So if you see things move in the right direction, let's hope they don't have to go as far as the 5.5% that they're guiding to, but I think they will need to get a couple more under their belt from where they are today.
Thanks. You've talked a lot about the easing, some of the easing concerns and some of it coming off. What do you think are those tail risks for 2023 that you're still worried about, geopolitically, COVID mutations, etc.?
Yep, the COVID one's a tough one to pick, but that's always there. I feel like the geopolitical one is probably top of mind for me. You know, there's still a lot of geopolitical risks out there, and that's something that's incredibly hard to predict or evaluate or plan for. We obviously saw the Russian invasion of Ukraine a year ago, and sadly that situation hasn't got a whole lot better. It hasn't got terribly worse, but it hasn't got any better either. So we'd like to see an end to that conflict. But you've still got things like the US and China bubbling away. There's still sort of Taiwan. There's other, we haven't talked about the Middle East in a while because there's been other things that there have been to focus on. But I feel like in markets, it's often the things that you're not worried about that sort of come out of left field and might hit you. So, you know, while we're all wrapped up in this whole interest rates, inflation, COVID, worrying about those things, we can't take our eye off sort of some of those issues that might be in the background.
Yep, that's certainly how it plays out. A question here from the audience: do you think that ESG momentum will be adversely impacted by the bearish, uncertain economic outlook?
Yeah, maybe it just slows down some of the interest in sort of ESG and sustainability investing. Big picture, no, I don't think so. I think that is just a snowball that sort of gets bigger all the time, and you know, it's so topical and so important to investors that it has to be important to corporates, fund managers, wealth managers, all of us in the industry. So I can't see that slowing down in a big picture sense. I guess where it gets tricky is that you have a year like last year where you know, you have commodity prices that are very strong, you have an energy crisis, and some of those parts of the market that are maybe not so ESG friendly, like the energy sector, actually perform quite well, and it reminds the average investor that they do pay a price in the short term for maybe having a sustainable investing approach, and that's not a bad thing, that's just a reality. It just maybe forces them to sort of firm up in their mind what they're trying to achieve and acknowledge that.
Going back to global, have we reached a tipping point with the population challenges in China and Japan?
Yep, well, Japan's had the demographics against it for years, and I think that is still probably the case. It's really tough. There's some great companies in Japan, but I really struggle to see to get positive on that part of the world from an economic perspective. Demographics is one reason there, you know, an ageing population. The whole world has an ageing population, so it's not just a Western world story, it's an emerging market and a China story as well. And obviously the confirmation this year that for the first time in I think 60 odd years China's population is shrinking is a reminder of that. Places like India still have a more attractive demographic profile when you're thinking about sort of growth and so forth. But yeah, the world has an ageing population, and that is something that we need to think about when we're considering, you know, investment themes, growth, what it means for inflation and other factors.
Great, thanks. Last question from the audience is, what is the outlook for company profits?
I think they probably look too high. You know, when you look at analyst forecasts, take the US market for example, and I always talk about the US because it's the biggest market in the world, the biggest economy in the world. So if we look at all the bottom-up analyst predictions for 2023 in terms of the calendar year, the expectation is that in aggregate you'll see a decline of 3 or 4% compared to 2022. It's probably still a little bit optimistic. Typically in a recession, and the jury's still out whether we have a recession. You know, if I had to have a guess, I'd say 60% chance in the US. So better than even, but not inevitable that we avoid it or that they avoid it. But if you do have a recession, then typically corporate profits fall 10 or 15%. So if you're in the recession camp and if you think it's going to be a tough year out there, then company profit forecasts are probably a little bit too high, and that's one of the reasons I think that a lot of us are just a little bit cautious about the market outlook. But, you know, time will tell. We're in the middle of the US reporting season at the moment. The New Zealand earnings season and Australian will start next month, so we'll get a good read on how corporate New Zealand is looking at that point.
Great, thanks. And just we have one last question before Richard pops back up here. Back to politics, national-led government. What one change do you think they might be pushing between now and the election around the economy?
Yeah, that's an interesting one. I think it's important to note that we actually haven't heard a lot from National about what their policy settings will look like. So as we get closer to the election, they will have to give us a bit more clarity about what they would do differently and be more specific about that. We haven't seen those specifics, so it's hard to judge whether they will be better or worse or just different, and you know, in what area. The housing market is probably something that I'm going to keep a close eye on, because I think that a lot of the policies Labor's put in place, whether it's sort of the interest deductibility or some of the other policy settings, have been quite unfriendly to the housing market, and that has probably exacerbated the decline that we've seen. House prices would have fallen anyway. That's probably made it a slightly bigger decline. For me, really important to monitor whether National would unwind some of those changes and make housing as an investment class look more attractive, because that obviously impacts those of us that are, you know, in other areas of the investment landscape. So that's something I'll be keeping a close eye on.
Perfect, thanks. Well, a lot for us to look out on over the next 6 months, following what has been a challenging period. Thank you very much for your insights, Mark.
Thanks for having me.